13, sir.
Yesterday, so today, before we get into the completion of this paper of the regulation, deferred taxation, now I wanted to talk about simulation questions on the CPA examination. Now, simulation questions, there are 8 simulation questions, and then, one is just a pre-test question. The remaining 7 you have to do. But the main thing I'm going to talk about simulations today is about the authoritative pronouncement simulations. Now, in the auditing paper and in the financial paper, the paper that we're doing right now, there are a lot of pronouncements. I mean, we know that we have generally accepted accounting principles, and whatever is codified, whatever pronouncement or policy is codified, and who codifies that? FASB, Financial Accounting Standards Board. It becomes a authoritative pronouncement. An authoritative pronouncement means that it is the pronouncement or the policy that needs to be followed. Similarly, and that is for financial paper. For auditing, we have generally accepted auditing standards. So even those standards are codified and they have a backup, and those standards are issued by the AICPA. So both in your CPA examination in the financial paper and in the auditing paper, you have, as a part of your simulation questions, you have at least 2 questions which ask you to do some research and come up with the authoritative pronouncement number or reference. Like yesterday, Priya sent me a question, and I thought that I'll just convey this to you. So that question was that there's a company, which buys an asset which has a life of about 20 years. And after using that asset for about maybe 2 or 3 years, the management decided that, the asset is not very useful. So they said it would only have a remaining useful life of 5 years. And the question was, what authoritative pronouncement helps us as professionals deal with this change? Now, so what they're asking you to do is to do some research, and you know that your CPA examinations have a tab which says authoritative literature. You have to click on that tab. You have to do some research. You have to come with a pronouncement. And, so in a pronouncement, you have a reference, like, say if I'm looking at accounting changes. So first thing, whenever you come, so the question is not going to tell you what topic you're required to research on. You're supposed to analyze that question. So I'm going to ask you that, suppose if the life of an asset gets reduced from 20 years to 5 years, what are we talking of?
It is a change in accounting policy, because now the estimation earlier we made is not relevant now. So we are going to change it.
So this is a change in accounting principle or policy. And now we have 4 or 5 kinds of changes. So what are those changes? We have a change in estimate. We have a change in accounting principle. We have a change in accounting entity. And then what is the last one we have? The last one is a prior period adjustment. I made an error 2 or 3 years ago. How do I correct that error? So this particular question deals with accounting changes, and very specifically, it deals with a change in, according to this question, it is a change in estimate, right?
Yeah.
Yes, sir.
And so when I'm trying to find the reference number for that pronouncement, I will put into the search column accounting changes / change in estimate. So then I will come up with, all the authoritative literature, the reference numbers, and then I will pick up those reference numbers. Now, so very important for anybody is to really narrow down your search to a very specific topic or a very specific concept. You cannot just write down accounting changes, because when you do that accounting changes, it is going to bring up so much literature. It's going to bring up references to accounting estimates, accounting policies, accounting changes in entity, and prior period adjustments. And then you can do a sub search. You can do a sub search But rather than going that route, be very specific about your concept, and then come up with that. So similarly, we studied lease transactions. So what makes a particular lease as a capital lease? So you would say conditions for a capital lease. Even then, you will have to say conditions from a capital lease from a standpoint of which party. Is it the lessee or is it the lessor? So now, how much experience do you need about remembering this literature, remembering the reference numbers? The AICPA does not require you to remember the reference numbers. The AICPA wants to know whether you are trained enough to do research and come up with the reference number. Becker material has many comprehensive questions on these research topics. And if you practice them properly, and do the research, you will know how to handle these questions. So that was the whole idea of maybe telling you that these are, and they are very easy questions. I mean, when I say easy questions, I mean, say if you know the answer, if you search properly, you can do a simulation question in 5-10 minutes at the most, unlike other simulation questions which could take you half an hour. So develop, as you go along, develop your skills of doing research on different topics. Even when it even if you don't come across a question, you can do your research. Say you want to find out about prior period adjustments and the reference number for prior period adjustments. So just experiment it. Open your simulation question, put in the search prior period adjustment, see what reference comes in. So in very simple terms, get used to the search tool that you have on your CPA material and start practicing that. So is there anybody has any questions on these kind of simulation questions?
Sir, will it include exposure drafts which are issued by FASB?
No,
Authoritative.
exposure drafts are not authoritative pronouncements as yet because they've not been passed. But what happens in the CPA examination is that they will put a question on exposure drafts in the examination and you will not know about it. You will not know about it. They will not tell you this is an exposure draft. They just want to see, like you have multiple choice questions about 70, I think 72 or 78, out of which, there are 6 or 7 pre-test questions. And pre-test questions are questions which could be on research topics or, evolving topics like that. Those are not considered for the examination, but you will not know which questions are those. So you will not be tested on a simulation question on exposure draft at all.
So my friend told there will be something called domino questions, which will not be marked or there will be no marks awarded. Are these the type of questions which you are referring in?
Probably yes. Yeah, probably yes. Any evolving topics, they might have a multiple choice question on that. They want you to attempt it, but it is not gradable. So there are no points awarded for that.
Sure. Thank you.
Okay, I would like all of you to join us in a seminar we're going to have, which is going to be in the first week of December, and this is a seminar on basically ensuring that your qualification meets the requirements to write the CP examination. There'll be very qualified technical speakers on this topic. So all of you should join it, and all of you should tell your friends and your colleagues, or if you're in the CA coaching industry, tell your friends to join this seminar. It's going to be a very useful seminar. So we're going to go now to the remaining topic now. What are these questions? All right, today we're going to talk about income taxes. And now income taxes, this is a financial paper. We are studying generally accepted accounting principles, and the rules for GAAP are different from tax rules. So that is the first thing that we need to understand. that we have, when we prepare our books, we have what is called book income. Book income is based upon all rules which are generally accepted accounting principles. How do you record this? How do you, they do not tell you whether they are deductible for tax purposes or they are non-deductible for tax purposes, or are they income or not income. So the first thing that you need to understand is that, oh, what is book income? So book income is derived by preparing your accounts and books as per generally accepted accounting principles. Now, the rules for accounting principles could be different from tax rules. Can somebody give me one example where these rules are different?
Depreciation.
Sorry?
Depreciation. As per books,
Depreciation. Depreciation is one example. Say, like in generally accepted accounting principles, we did study that depreciation has three methods. We got the straight line method, we got the double declining method, and the sum of year digit methods. And they tell you calculate the useful life, calculate the salvage value, and come up with the depreciation to be booked in your book income. Okay. But for tax rules, we haven't studied regulation, but for tax rules, we have what is called a modified accelerated cost recovery system, MACRS. Now, what MACRS is, it does classification of assets: class 3 assets, class 5 assets, class 7 assets, class 29 assets. And so each asset group has been given a specific duration of life. So like if I'm looking at, say, class 5 is all fixtures and furniture and things like that. So it has already been specified they have 7 years of life. 7 years of life. So then also in the modified accelerated cost recovery system, we have a mid-quarter convention, a semi-year convention, or a mid-month convention. Basically, what is mid-quarter, mid-year, or mid-month means that I will calculate depreciation if I buy, say it's a mid-year convention. I will only, if I buy an asset in March, I will still take 6 months of depreciation, like that, because I take the mid-year. So we'll study those rules when we come to regulation. So here we have book income, and then the tax rules are different, and we have taxable income. Now, the income tax expense which I book in my books is based on my book income. Suppose my book income is $100,000, my tax rate is 20%. So my income tax expense as per the books would be how much? 20,000, right? 100,000 multiplied by 20%, which is the tax rate. But for tax purposes, my taxable income is not $100,000. It is maybe $80,000. Why is it $80,000? Because I took more depreciation for tax deductions by 20,000 more. So my taxable income is 80,000. How much do I pay the government?
16,000.
16,000, right? 80,000 multiplied by 20%. So I have booked an expense of 20,000. I pay only 16,000. So that will have what will it have? A
deferred tax impact.
It will have a deferred tax liability because my taxable income is less than my book income. So here we get into, in this chapter, we're going to talk about deferred taxation. So the first thing that we need to understand is that we're talking of book income, which is determined in accordance with generally accepted accounting principles. And your income tax expense and payable might be different, just like what I told you. So what is intra-period tax allocations? What do you understand by intra-period tax allocations?
This will be the advanced tax assessments that I will make, and I will do a presumptive tax liability created.
No, intra-period, when we're not talking of tax liability, intra-period allocation means that within your financial statements, you're calculating tax on different components separately. You know that, in your income statement, we have to show earnings per share, right?
Yeah, yes.
Okay. So can somebody tell me, and we did discuss this, that what are the items which are shown on your income statement before tax, and what are the items that are shown after tax? Anybody remembers? Okay, let me recap the income statement again. Just, try to picture this. You've studied this in financial one. We have net income. After net income, we have sales. Not net income, sorry, we have sales. After sales, we have cost of goods sold. And we come up with, what do we come up with?
Gross margin.
Gross margin or gross profit. From the gross profit, we deduct, selling, general administration expenses, and we come up with
Net income.
net income. The word net income is always a terminology used after deduction of tax. So we come up with income before taxation. Okay. Then we have other gains and other losses. That gains and losses are always they're always stated net, but not net of taxes. When we say net, what do we mean?
Net of tax.
Not net of tax. No. When we say net means if I sell a building for $100,000 and the cost of that building was 50, I will not say sale of building 100,000, cost of building 50,000. I will net them off. I will say gain on a sale of a building 50,000, but they are not net of tax. So after my income before taxation, I put other gains and losses, and I come up with what is the terminology called?
Income before usual item and income tax.
Yeah, income before unusual items, and we take unusual items also. And when do we use this terminology, income from continuing operations?
When we have
When
discontinued
we have
operations also in the same year.
When you have discontinued operations. So the first thing to understand is that income from continuing operations is one figure on which you show tax. Okay, so my income from continuing operations is $100,000. My tax is 20,000. My income from net income from continuing operations is 80,000. Okay, so intra-period means allocating your tax portion on different segments of your income. Discontinued operations is always stated
net of taxes.
net of taxes, right? When I show discontinued operations in my income statement, I say discontinued operations net of taxes.
Yeah.
Income from continuing operations, I show income tax separately. In discontinued operations, I show this net of tax. Then all the accounting changes that we have, a change in accounting principle, a change in accounting entity, are always shown net of tax, right?
Yeah.
Okay. All the items which go to OCI are always shown all OC items are always shown net of taxes, right?
Yes.
Okay. So intra-period means allocating the tax portion between various segments of the income statement. So we have income from continuing operations. We show the income tax separately on this. Discontinued operations is shown net of taxes. All accounting changes, principles are shown net of tax. All OC items are, and the OCI items, right?
Yes, sir.
Pensions, unrealized gains, they're all shown net of taxes. So the word intra-period means showing the tax portion separately on that. Okay, now we have inter-period. What do you mean by inter-period? This is intra and this is inter. Inter-period means this year versus last year. Okay, why would we have this year versus last year? Why would we have differences?
Deferred tax.
Deferred tax, exactly. Because your deductions are different. Your deductions and revenue items could be different from your book income. So get used to these two terminologies: intra-period within the income statement and intra-period within periods, like 2021 versus 2022. The other concept is financial statement income is also called book income, and this is as per FASP, as per generally accepted accounting principles, your financial statements. And this is your income tax return, which is based on IRS tax code. So the difference between the book income and the IRS income and the tax return income is these are differences. Now the differences can be permanent or temporary. What do you mean by permanent or temporary?
Permanent are those which are not reversible.
Which are not reversible, exactly. Do you know of any item that you haven't studied regulation, but do you know of any item that is a permanent difference?
Example, R&D expenditure, sometimes we might take a higher rate of deduction as per income tax, but in books we might use amortization. So this might result in a difference which will be a permanent difference.
Why would that be a permanent difference?
Because this is not reversible, because we have to go as per the IRS in case of R&D expenses.
Okay, so this is partially correct, because sometimes what happens is any depreciation taken for tax purposes before say 1987 is non-deductible. So that makes a permanent difference. To give you a very easy example of a permanent difference is penalties and fines. Say when my driver, like say my truck driver is driving on the highway and he's speeding and he gets a fine, he gets a speeding ticket of $100. Is that deductible for financial statement income or not?
Yes.
Yes.
Yes. Yes.
All entries that we have, all transactions are either recorded as income or either recorded as expense or asset or revenue for book purposes. But for tax purposes, that penalty is never deductible. Okay, so is that a permanent difference or a temporary difference?
Permanent difference.
Permanent difference, because it will never reverse. What is an example of a temporary difference?
Depreciation.
Depreciation is an example of depreciation. Amortization is an example of temporary differences. Okay, so everybody's clear about permanent and temporary differences, right? So I'm going to ask you one question here. My book income is before taxes is $100,000, is $80,000, and my tax rate is 30%. But included in that $80,000 is a deduction of $20,000 of penalties. So how much is my income tax expense?
16,000. 24,000. 80,000 into 30%. The 20,000 penalty will be disallowed as per IRS.
Since 20,000 is disallowed, I'll add that back to 80,000. So on 100,000, I'll calculate my income tax expense.
So what is my income tax expense then?
30,000.
30,000.
Exactly. It is 30,000. It won't be 20,000. It won't be 24,000 because the 20,000 deduction which I took in my books is not allowed. Okay. So my taxable income comes to 100,000. Whether I will pay 30% on that 30,000, I will not get any relief in my financial statements. So even in my financial statements, I will book an income tax expense of how much?
30,000.
30.
30,000. 30,000 because it's a permanent difference. So always remember, on permanent differences, we have no deferred taxation. Whatever I pay to the government is what expense I book. Okay. Now let's take a temporary difference. Suppose this was not penalties. This was depreciation. So now we'll reverse it a little. My book income is 100,000. My financial statement income and book income, which is the same thing, is 100,000, and my tax income is 80,000. So how much is my income tax expense? Okay, so how much is my income tax expense recorded in my books?
30,000.
How much?
We take 30,000. If we take 30%, 30,000.
Our income tax income is 80,000, so it should be 24,000 as a income tax expense for the year, and I think 6,000 would be a temporary deferred tax.
Exactly. So in my books, in my financial statements, my total income tax expense is 30,000, 100,000 times 30%, 30,000. But my current income tax expense is 24,000. So what that means is I've booked an expense of 30,000 and I've only paid 24,000. So that will be shown as a
Deferred tax liability.
deferred tax liability. Okay. And if it is the other way around, suppose I pay 30,000 to the government, but in my books, I book an expense of only 24,000. Then I'll have a deferred tax
Asset.
account. So is everybody clear about asset and liability, deferred tax asset and liability? Okay. So when do I have a deferred tax liability?
When I pay less.
Exactly. When I pay less. I have a deferred tax asset when I pay more. So the next thing is, so all these deferred taxes will be cleared in the future. Is that clear?
Sir,
How will it be? Let me give you an example. Say I have an asset of $100,000. How much is the total depreciation I can take on that asset?
As per the life, we'll use SLM method.
No. What I mean is, like, I have an asset of $100,000. What is the total depreciation I will take on that asset? 100,000, right?
Complete
I
100.
want to write off that asset to zero. So I will take 100,000. Now, if I take on a straight line method in my books, it will be, say, 20,000 per year. I have a 5-year asset. But in my tax purposes, I might take 40, 30 and all this stuff. But over the life of the asset, over the life of 5 years, the deferred tax account will clear out, right?
Yes.
Because the total depreciation for both book and tax purposes is the same. Okay, so you've got, you understand the deferred tax liability, you deferred tax expense, what is the current income tax expense, what is the deferred income tax expense. Now, the second question that we come up with deferred taxation is, are they current or non-current? So what makes you decide whether a particular deferred tax item is a current item or a non-current item?
If the period of reversal is less than 12 months, it is current. If it is more than 12 months, it is non-current.
Exactly. If the period of the reversal is less than 1 month is current. So for depreciation, it is always
Current.
why?
No, sorry, non-current. Non-current. Because the
Non-current.
life
Because
of
depreciation is going to reverse over 5 years, it's going to be non-current. So you got the concept of deferred taxation, you got the concept of permanent differences, temporary differences, you got what is current taxes payable, future taxes payable, which leads to a tax liability or a deferred tax asset. And then so permanent differences. Permanent differences are items of either revenue or expenses which will never be reversed. Now, most common, I'll give you some, and then when you do your regulation paper, you'll know about all the differences. Like there is one interest income, which is never taxable. And what is that? Interest income on state or municipal government bonds. So if a company has invested in state bonds or municipal government bonds, that income is never taxable. Is it income shown in your book income?
Yes, it will be shown in book income.
It will be shown in the book income, but for tax purposes, it is never taxable. So this is an example of a
Permanent difference.
permanent differences. Dividend received deduction. I have a subsidiary. The subsidiary gives me, I have 60% ownership in that subsidiary. The subsidiary gives me $100,000 dividend. Okay. Now, is that dividend taxable or non-taxable? I mean, we'll study the rules later on, but just to tell you, depending on the ownership, the dividend received has a dividend received deduction, which is a permanent difference. 60% of the dividend is non-taxable, 80% is non-taxable, 100% is non-taxable. If I have more than 80% ownership, 100% of the dividend received is non-taxable. That will become the percentage of deduction will become a permanent or a temporary difference?
permanent.
Permanent difference. So these are income items, and expenses I showed you. I told you fines and penalties are non-deductible, so they are permanent differences. And permanent differences will not result in any kind of
Deferred tax impact.
exactly no deferred tax impact on permanent differences. Now we come to temporary differences. Temporary differences are, I deduct something now versus later. I include something in now versus later. And examples of these ones would be, of course, depreciation and all that stuff. And so that is, just remember, we discussed about permanent differences. So comprehension allocation is referred to the balance sheet approach. When it will reverse, whether it's a liability or a tax asset. That same thing you'll do now. Current income tax expense. What is it? Current income tax expense. How do you calculate current income tax expense?
Taxable income into the tax rate.
Exactly. Taxable income to the tax rate. How do you calculate total income tax expense? Book income times the
Withholding taxes.
not what do you say withholding taxes?
No, like my tax payable on assessed income plus the withholding tax will be the total income tax payable.
Yeah, but no, total income tax expense, I mean, not the liability. What is my total income tax expense? Sometimes the CPA question asks you, calculate the current income tax expense. So all that you do is, how do you calculate current income tax expense again?
Taxable income into tax rate.
Taxable income to tax rate. Calculate my total income tax expense. It is my book income times the tax rate. Calculate my deferred income tax expense. That will be the difference between book income and taxable income times the tax rate. But that difference should be
temporary.
Temporary, should not be permanent. So is everybody clear about the current income tax expense, total income tax expense and deferred income tax expense?
If you can
Yes.
come again on the total income tax expense. It would be current income tax expense plus the deferred taxes.
Exactly. It will be the current income tax expense plus the deferred taxes. That will be a total income tax expense.
Okay.
Okay. So look at the current income tax expense. In current income taxes payable plus or minus the deferred income taxes is total income tax expense. This is as per your books. This is as per your tax return. And this is the differences here. Here, current income tax expense times the current rate is the current liability. Total income tax expense is the financial statements times the current rate, and deferred will be this one here. Now, one thing about deferred taxation is that your deferred account will reflect what rate will it use.
It will use the future enacted rate.
It will be the future enacted rate. Suppose if today the rate is 32. Say today the rate is 30%. Next year, the government has already announced that the rate will be 25%. So because it is going to reverse at 25%, so my deferred tax liability will be set up at what rate?
25%.
25%. So remember this concepts also. The tax return, current income tax expense is your taxable income times the current rate. Financial tax is your financial income times the current rate. Deferred taxation is only for temporary differences times the tax rate. What is the deferred amount will depend upon what year it is going to reverse and what is the tax rate in that year. And it will be an asset when deferred. I'll have a deferred asset when
I pay more.
I pay more, which means my current tax expense is more than my total expense, right?
Yes.
Okay, got that. Everybody's got that. Okay, so let's read this pass key. Total tax expense for financial statements is a combination of current tax plus or minus deferred taxes. The CP examination frequently provides an incorrect calculation of financial statement income times the current rate. This is incorrect because it also deals with permanent differences. And then you also look at the tax rates in the future and your permanent differences also. Now we talked of permanent differences. No deferred taxation on permanent differences, right? We discussed that. Examples of permanent differences. Okay. One is tax exempt interest, municipal and state. Okay. So you sometimes, these 5 or 6 things you have to remember. You might have a multiple choice question on that. What is a permanent difference? What is a temporary difference? The question will say, does this lead to deferred taxation or not? And you have to pick up yes or no. So tax income on municipal and state government bonds. Life insurance proceeds on an officer's key man policy. What does that mean now? Life insurance proceeds on an officer's key man policy. When you read that line, what comes to you? What does it mean exactly? How do you interpret that?
Life insurance premium paid for somebody like some officer, director, CEO of the organization.
No. Life insurance proceeds on an officer's key man policy. What message does this line give to you? Life insurance proceeds on an officer's key man policy. Okay. The company has taken a life insurance policy on a director. The director passes away. The company receives $100,000. That is life insurance proceeds. I'm getting money on that life insurance because the director has passed away. That is non-taxable. It is a It is a temporary or a permanent difference?
Permanent difference.
Permanent difference. So this is life insurance proceeds. Now, the next line, I want you to read this and tell me what you understand. Life insurance premiums when the corporation is a beneficiary. What does that mean?
So organization has paid the premium amount where corporation itself is a beneficiary, like for something corporation has been
So
secured.
why is this a permanent difference?
Because I think its corporation is a separate entity, and I think for tax purposes, it
So
should
the
be.
rule is that if a company takes insurance on one of its main officers, directors, and that officer dies, and the company gets all the proceeds, those proceeds are non-taxable. But even the premium paid by this company to get that life insurance is non-deductible. Is that clear? Life insurance premiums paid by the company to get life insurance on a key man, officer, and the company's beneficiary is non-deductible. Is that clear? Did you understand that now?
Okay, both the AR and like both the
Exactly.
receivable and payment.
The proceeds are non-taxable. The premium is non-deductible
Okay.
when the company is beneficiary. Certain fines and penalties, which I discussed, those are non-deductible, permanent differences. Non-deductible portion of meals and entertainment expenses. The IRS has a regulation which says that only 50% of your meals and entertainment will be allowed as a deduction. So meals and entertainment will lead to what?
Permanent difference.
Permanent difference. Okay.
Is it because it is taxable as a perk in the hands of the employee? Is it because
No, it's not taxable in the hands of the employees. This is just a general selling expenditures, but it is not taxable. So 50% of the meals and entertainment expenses, like I'm the director of a company and I take a party out for lunch. It will not be taxable. It will not be taxable in my hands. And okay, let's take one example. A company spends $100. The CFO of a company takes somebody else out for lunch on behalf of the company and spends $100. Now, is that taxable to the officer? No. How much deduction is allowed in books?
$50.
No. Again, listen, read the question. How much deduction is allowed in the books?
100%,
$100. How much deduction is allowed for tax purposes?
50%?
50%. So the remaining 50%, will it lead to deferred taxation or not?
No,
Why?
permanent difference.
Exactly. It's a permanent difference. So you got that concept, right? Dividend received deduction, we discussed that, right? Dividends received depending on ownership are never taxable. So that is a permanent difference. Excess percentage depletion over cost depletion. So basically, what does this mean? This is just like if you for depletion, if you take over the cost depletion, then that is a permanent difference also.
Is it similar to the first example that you quoted when the class started? Example, an asset had 20 years, but later the company decided that only 5 years.
No, it's not similar because when we talked of depreciation, that was a temporary difference. Here, this is a permanent difference, and this is depletion. For mining resources, if a company takes more deduction than the cost, that is always disallowed. It is not allowed. So it is a permanent difference. Okay, this is also something you'll have to remember. The deduction of business interest expense is limited to the business interest plus 30% of the adjusted taxable income. This is a new rule that has come in. So what does this line mean to you?
So there is a cap on the interest expense that is allowed to be treated as a deductible item.
Okay, how much is the cap?
Income, business interest income plus 30% of adjusted. So we'll have to arrive at what was the business interest income plus 30%
Okay,
of adjusted tax.
let me you read that line and I'm going to give you a question. My total interest expense is $100. My interest income is $50 and my taxable income is $50. How much deduction am I allowed?
It will be 100 plus 50 into 30%.
No. Read the question. Let's do the question again. My interest expense is $100. My interest income is $50, and my adjusted taxable income is $50. How much interest expense am I allowed to deduct?
$65.
How much? 50 plus?
65, 50 plus 15.
$65, exactly. So though I'm spending $100 interest expense, I'm only allowed to deduct my interest income, which is $50 plus 30% of the income, which is $15 more. So I can only deduct $65. The remaining is a
Temporary.
is a permanent difference, right?
Yeah.
Okay, so let's do this example here. ABC company reported $200,000 of pre-tax income. Pre-tax financial income, book income. Always read whether it's book income or tax income. Included in this income was $100,000 of life insurance premiums of policies on which the corporation is a beneficiary, and the interest income of municipal bonds. Are both of these permanent differences or temporary differences?
Permanent.
Permanent. Okay. So here we got income of $200,000. You have to minus municipal interest. You have to add municipal interest income, and then you have to deduct premium $200,000. Okay. How much is my expense here now? How much is my current income tax expense?
Current income tax expense is 33,600.
Okay. How much is my total income tax expense?
It's same.
Same. And because both these are permanent
differences.
right? So what you'll have to do is you'll have to calculate your pre-tax financial income. So this is your total income. You have to minus this one because it is not taxable, non-deductible. So 250, so 160 plus 50, 210 minus 100. So you have to only pay tax on this much. And what is my tax rate?
21%.
Okay. So what is the entry you will do for this? You won't have any deferred entry, right?
Yeah.
Income tax expense expense to income tax payable 33,600. Now we come to temporary.
Sir, can you please explain why did we add municipal interest 50,000?
Say that again.
Why are we adding 50,000 municipal interest?
Okay, remember now what is my total income? My total income is $200,000, right?
Right.
What does that include?
The life
That
insurance
includes 50,000 of municipal interest bond. Is that taxable?
No.
No. So 200,000. So I'm just going to calculate my taxable income now. 200,000 minus 50,000 gives me 150,000. Now this then I paid 10,000 premium. Is that deductible?
No.
No. So I add it back. So I can do, I could have done it the other way around. I could have taken 200,000 minus 50,000, 150,000 plus 10,000, which is non-deductible, which will bring me to an income of taxable income of 160 times 21%.
Okay.
Okay. So everybody clear about how he did this? He did it in a different way. I would have started with 200,000. I would have minus 50,000 and then added 10,000 and come up to 160 times 21% and have made that entry. Now we come up to temporary differences. Temporary differences cause deferred taxation, and that will result in a deferred tax asset or a liability, right?
Yes.
Be clear about that, right?
Yes.
Okay. So we're going to take some. So what could happen is, okay, we could have financial statement income first. I include this in income, but in tax returns, it is income later. What are the examples? Installment sales, contractors, accounting, all the stuff here. So this is one situation where I book the income in my books, but for tax purposes, it is non-taxable. Second situation is I book the income in my tax return, but in financial statement, it is later. Okay, so that will be, example is prepaid rent. Okay, one couple of difference. I mean, these things I'll just tell you right now. So in tax rules, suppose if somebody pays me 18 months of rent, how is that rent recorded in my books?
As a prepaid rent of next 6 months.
Exactly. So in my books, I will have income of only 12 months. But for tax purposes, I will have income of how much?
18 months.
18 months. Okay. So remember that prepaid rent is immediately taxable. Prepaid interest is immediately taxable. Prepaid royalties. So here I've received the income and it becomes taxable immediately for tax purposes. So this is income in the financial statements first, income in the tax return first, expenses in the financial statement in the financial statements first, and expenses in the tax return first. Now let's look at expenses in the financial statement interest. One example of an expense which is immediately deductible is what? Provisions, right? Provisions for bad debts, right?
Doubtful debts.
Doubtful debts. So bad debt expense, we make a provision, 3% of my accounts receivable is a bad debt expense. I deduct it. But for tax purposes, it is not deductible till you
Record it as a bad debt.
write off that receivable. You know, that person has gone bankrupt and all. Okay, so here income tax expense first in the tax return and in the books later. Example would be depreciation, because I'm claiming more depreciation in my tax return than in my books. So is everybody clear about these 4 situations which would result in deferred taxation? Right?
Yes. Yes.
Okay. So we're going to go through this example now, and this will explain everything. Stone Company began operations in year 1 and reported $225,000 in financial income for the year. So this income is shown where?
Books.
In the books. So always remember, financial incomes is books as per generally accepted accounting principles. Stone Company year 1 tax depreciation exceeded the book depreciation by 25,000. Okay. So how much will be the taxable income?
200,000.
200,000, because I'm claiming more depreciation here. So my book income is 225,000. I claim more depreciation of 25,000 for tax purposes. My taxable income comes to $200,000. How much is my current income tax expense?
42,000.
How much is my total income tax expense?
47,250.
And how much is my deferred income tax expense?
It's 5250.
Okay, so you got this concept. Current income tax expense, total income tax expense, deferred income tax expense. Now about deferred income tax expense, we are using the tax rate of how much?
21%.
21%. Okay. Now, what does that imply to you?
Enacted. Future enacted.
What does that 21% mean to you? That even in the future, when that 25%, okay, firstly, is that $25,000 a current asset, a deferred current asset, or a liability?
This is a liability.
Liability. Is it a current liability or a non-current liability?
It is a
Non-current liability.
Non-current liability, because it is depreciation, it will reverse over the life of the asset. Okay. Why is it 21%? Can somebody read a line in the question which tells you why it is 21%?
Stone's tax rate for the year one and years thereafter was 21%.
Exactly. This. So what they're saying is Stone's tax rate for the year one and years thereafter was 21%. So it means even in the future, the tax rate will be 21%. Suppose if the tax rate was 20%, how much would be the deferred tax?
5,000.
5,000. Suppose the future tax rate was 20%. So the deferred tax would be 25,000 times 20%, 5,000. So is everybody clear about this concept of deferred taxation, tax rates, current income tax expense, total income tax expense, deferred asset, deferred liability, current, non-current?
Yes.
Okay, great. Okay, look at the journal entry in year one now. Current income tax expense, 42,000. Deferred income tax expense, 5250. Deferred tax liability, you're going to pay this later. It's a liability, 5250. Income tax payable right now is 42,000. Now in year two, this deferred tax liability reverses. So what will you, how will you record that entry? You will remove this liability and you will remove this deferred tax expense account because you've already recorded this. So your entry will be deferred tax liability. This will be reversed and this will be reversed. Everybody clear about this? Hello?
Yes, sir. Yes.
Okay. Okay, I want you to do these two questions. Okay. Zef company prepared the following reconciliation of its pre-tax financial statements, income to taxable income. So we got pre-tax financial statements. These are before taxes. Non-taxable interest received from municipal security. What is the question asking? Calculate in its income statement, what amount should ZEF report as income tax expense current portion? So current portion will be
1,40,000 into 21%. It would be
Okay.
B.
So what they're saying is that 160 is my pre-tax income, pre-tax financial income. This, okay, you have to deduct 5,000 because this is
Permanent difference.
permanent. Long-term loss accrual in excess of deductible amount, permanent difference. And you have to add it back because it was deducted to arrive. Depreciation in expense of this much is this much here. So this is a temporary difference, and then you will come up with a tax rate of 21%. So that is the answer for that. Here, you look at this 160, financial statement income 160. This is a permanent difference. You have to deduct it. This is an estimated loss. This is also permanent. This is also permanent. Excess depreciation disallowed. Okay, you want to do this question?
Yes, sir.
Again, book income this much. This is permanent. This is permanent. This is permanent. Now, what is the question? What should be reported as deferred tax liability? Deferred tax liability will be only for the temporary differences. 25 minus 10, 15 times 21%, 3150. Same question, but right now they're not asking you to, they're asking you to calculate deferred tax liability. So that would be that one there. Okay, deferred tax asset. When does a deferred tax asset arise?
When we pay more than the current expense.
Okay, when you're paying more to the government, so which means your current income tax expense is
Higher.
higher than the total expense. So we have a deferred tax asset. Now we have what is, you have to also a new concept is called the valuation allowance or a contra account. Now when do you think you'll have a valuation account?
Case of an asset getting abandoned or its life is lesser than the original estimate.
Exactly. So basically remember that a valuation allowance is done when there is no chance of a reversal. Okay, suppose in my deferred tax account, I have a deferred tax asset. Now this is for an asset, right? I have a deferred tax asset of about maybe $30,000. And I'll give you an example. So let's take a business. There's a business that makes a loss in the year 2020. It's $100,000 loss and the tax rate is 40%. So now you don't have any income at all. There's a loss. Now what are the rules of IRS say? That the loss can be carried backwards and carried forward. It can be carried. So just listen to this example and you'll understand what that allowance really means. So because I have a $40,000 loss, it is a potential Sorry. I have a $100,000 loss, and the tax rate is 40%. Okay, that and the provisions are that the loss can be carried backwards 2 years and forward, say 10 years. I'm just giving an example. 2 years backwards, forward 10 years. Now that $100,000 loss is a potential asset or a liability for me.
It will create asset for me.
Pardon?
It should create a asset for me because
Exactly. It should create an asset for me because I can reduce my last 2 years of taxes and my future 10 years of taxes. So, okay, now let's see what is the valuation allowance. So out of that $100,000 loss in the previous year, I also had a loss. I had a loss of 30,000. And then in the previous year to that, I had a profit of 50,000. Now, so what will I do? I will go back and amend the return for the second previous year and reduce my tax liability by how much?
80,000.
50,000 times 40% is 20,000, right? You got that 20,000, right?
Yes.
The total asset, the total potential asset is $100,000 loss times the tax rate of 40%, 40,000. Out of that 40,000 asset, I'm using 20,000 in the second old year. So I still have a potential asset of 20,000. Okay. So in my books, I'm setting up with a deferred tax asset account of 20,000. So now I have how many more years to go forward? I could go backward 2 years and forward 10 years. How many years forward do I have? 10 years, right?
yes, sir.
I can offset that loss for the remaining 10 years, but I do not anticipate any income in the next 10 years. So that deferred tax asset which I have will expire, right?
Yes.
Yeah.
Okay, so I have to do a valuation allowance. I have to get rid of that asset and book a valuation allowance. When the probability of the asset reversing not happening, it will only is less than 50%, I'll take a valuation allowance. I'm going to do this question with you and then you'll understand it a little better. Okay, deferred tax asset account. Black company. So always remember, if there's more likely than not, 50%, less than 50%, it will not reverse, it will not be realized. So I have to make a valuation allowance. Black company organized on January 2nd, year 1, had pre-tax accounting income of 500,000 and a taxable income of 800,000. Now, is this a deferred tax asset or a liability account?
Asset.
Asset account. Why is it an asset account?
Because
my taxable income is more, right?
yes.
I'm paying higher. This is my taxable income, 800,000 times 21%. I'm paying 168 now. And 500,000 is my book income, this much. So I have an asset. I have paid more now and I will get that money back. Why have I paid more now? What could be the reasons?
I could have prepaid rent income or
Prepaid rent income, exactly, or things like those. Okay, so what is the entry here now I will do? Remember now, current income tax expense. Current income tax expense, taxable incomes times the tax rate, 168. Okay, current income tax payable, 168. Deferred income tax benefit, 63. Deferred tax asset, 63. Is everybody clear about this entry?
Yes, sir.
Okay. Okay, when the company pays the warranty cost of 100,000, the company will take tax deduction relating and will receive out of that. So basically all that they're saying is that when I actually warranty expense is exactly like what? Okay, the two rules that you have to remember is about provisions. Provisions are deductible for book purposes, but not for tax purposes. Say now the company set up a warranty provision, it deducted it to come up with 500,000, but this was refused for tax purposes until it is paid. Now you have paid it, so this deferred tax asset account will reverse by 21,000. Is everybody clear about 21,000?
Yes, sir.
So how much expense did he pay? How much expense did the company pay?
Nothing, because we already have deferred asset for this
So
expense.
how much expense did the company actually pay?
In the year 2,
In this particular year, when I'm reducing my asset by 21,000, how much expense did the company pay for warranty?
100,000.
100,000, right?
yes,
I paid 100,000 times 21%. So this is reducing my deferred tax asset account from 63 down to 42. Is everybody clear about the deferred tax asset account now?
yes,
Okay. Now valuation allowance. Same question. Black expects to have a taxable income of 100,000 in year 2, but no taxable income after that. Prepare a journal entry to record the deferred tax asset account and liability account. Okay, the deferred tax asset account will be limited to the amount realized in year 2 of 21,000. So now what they're saying is that in the future years, I'll have no taxable income at all. So I will not be able to reverse any deferred tax liability. So I have to totally reverse 42,000. I could reverse 21,000, but after that, I will not be able to reverse it. So I have to totally write off this 63,000 and do a valuation adjustment of 42,000. Is everybody clear about this 42,000?
no, sir.
Okay, what they're saying is, all right, let's go back here. 1 minute, let me go back to this question here now. Okay, this difference of $300,000 is warranty provisions, which resulted in an asset of 63,000, right?
Yes,
Okay, now my taxable income is 800,000 because I have not actually paid the warranty expenses. I've just done a provision. So I have a deferred tax asset account of 63,000, right? Look, next year I pay $100,000.
yeah,
So I reduce my asset from 63 down to 42.
yeah.
After that, what they're saying is there will be no more payments to be done. Like for example, suppose if I sell a car and I provide warranty for 3 years. In the first year, I spend $100,000, right? In the next 2 years, I don't spend anything. So will I get any benefit?
No.
No. So after 3 years, there's no more warranty, right?
Yes.
Okay.
So that will be a reversal. Is that clear now?
So we are reversing the provision in our book and as well the deferred tax.
We are taking the asset account because it will not benefit us anymore because the warranty period has expired. Is that clear?
Okay. So we still debited deferred tax asset. We should have credited deferred tax asset and then.
Okay, let look at this entry here. originally what did we do? We set up a deferred tax asset account by 63,000.
Yes.
We have to get it down to zero.
Yes.
We made an entry of 21,000, which is what?
Reversal of the deferred
No,
tax.
which is the expense of 100,000 that we paid. Now I have to review, how do I get this down to zero? I have to credit 42,000. So I have to get this asset 63,000 down to zero. I will minus 21 and I will put a credit of 42,000. That is how you make an allowance. You have to get your debit deferred tax asset account to zero. Is that clear?
Yes, sir.
You know, if I'm removing an asset, I have to reverse that total asset down to zero. So I'll get that one there. Okay, let's do this example, temporary and permanent differences. Fox Incorporated financial statements and taxable income for year one follows income. Income before tax related difference is 140,000. What did see that again? Okay, Fox financial statement taxable income for year one follows income before the effect of tax related is 140,000. Okay, so what they're saying is 140,000 is the income. Financial statement pre-tax income is 115,000. So what are the difference? One minute, let me read this question again. Fox Incorporated financial statements and taxable income for year one follows. Income before the effect of tax related differences is 140,000. Okay. So financial statement pre-tax income is 115,000. This is given to you. Differences are 12,000 permanent difference. So you have to minus it from this income because this is non-taxable. Penalty expense, you have to add it back because it is non-deductible, right? Depreciation, you have to add it back because it is a temporary difference. Why are you adding it back here? What is the difference between 10? What is the difference between 10,000? What does this mean here? I took book depreciation of 30,000. My tax depreciation is 40,000. So my taxable income is minus 10,000, 100,000. Is this clear how I did this? Okay, so just to tell you again, before any differences, my book income was 115. Okay, and it includes 12,000. I have to deduct it because it is permanent. It deducted an expense of 7,000. I have to add it back. Now to arrive at the taxable income, because I deducted 10,000 more depreciation, I have to deduct it. My taxable income is 100,000. Now what is the question asking us? Okay, I'm going to ask you a couple of questions. What is my current income tax expense? Assuming the tax rate is 21%.
Current income tax expense would be 21,000.
Pardon?
21,000.
21,000. How much is my total income tax expense?
Okay, it would be
140 into 21%.
no. It would be
No.
10,000 into 21%. So
115 into 21%, and the remaining is a deferred one. Permanent differences you do not take into account.
yeah, so
It is 140 minus 19, 115. 115 is the permanent difference here. No. So 115 is the book income.
yes.
And on this one, I will take 21%. Let's look at this one, what he did here. Okay. So I've got my taxable income was 100,000. Let's see. 100,000. Okay. So my total tax liability is 21,000. My pre-tax income is 115,000. 21% of this. Always remember, my total expense is always my book income times the tax rate. And in my book income, I will not take permanent differences. So it is 115, which is given here to you, 115 times 23. And this is the deferred taxation. Deferred taxation only arises because of depreciation. Is this clear how we did this?
Yes.
Okay. I'm gonna go with this question a little more. 140,000 is considering all this. So I take 140,000. I remove this is a permanent difference. This is also permanent difference, 145 minus the depreciation. So my book income is 115,000 after ignoring the permanent difference. Temporary is 10,000 and taxable income is this much. So what is the entry for that you will do? Income tax expense current is your taxable income times the tax rate, 21,000. So income tax expense current 21,000, income tax expense deferred 10,000 times this much. Is it a liability or an asset?
Liability.
Liability.
Why?
Because
Taxable income is less than.
Because taxable income is lower, right?
yes.
Yeah, it's a liability. And then you have this entry here. So always remember, total income tax expense is based on this number, current is based on the taxable income, and the remaining is a deferred one. Only after adjusting for permanent differences. Okay, so now we go to the next module, which is tax positions. Now, what do you mean by tax positions? A tax position basically means one of the companies says that I think this particular expenditure which I'm doing on research and development in this country is deductible, or this investment that I'm doing is non-taxable. So I take an approach. So whenever I take an approach and I take a deduction or as an expense, or I don't consider it as an income, the rules are that your chances of winning have to be more than 50%. So recognition of the tax benefit, you will only recognize tax benefit if the probability of that particular position is more likely to happen by more than 50%. Is that clear? Did you understand what this?
Yes.
Did you understand what we're discussing here?
Yes. So the contingency, the chances of a benefit happening is more than 50%. I would recognize.
Exactly.
Deferred tax.
If it's happening more than 50%, I will take that deduction or the tax benefit. If it is less than 50%, I will not take that example. So now we come to how do you measure that benefit? So the key thing is more than likely and by 50%. That is a tax. One multiple choice question you'll get. Just remember that 50% more than likely, and this is how you calculate the benefit. Okay, greater than 50% and all the stuff. Okay, let's look at this example here. Fox Incorporated prepared its year 1 tax return. Fox Incorporated has taken a tax deduction of 2,000 that results in a tax saving of $420. How did that tax saving come to 420? How did you get tax saving of 420?
21% of 2,000.
Exactly, because if I'm taking an expense, I'm paying less tax by that amount. So 2,000 times 21%, 420 is the benefit. Fox believes that. Now, the chances of this expense being allowed should be how much percentage of your being allowed this expense?
1,000. 50%.
right? Okay. So Fox believes that there is a greater than 50% chance, if audited, that the tax deduction would be sustained as filed and meets the more than likely test. However, Fox concludes that if challenged, it would negotiate a settlement. The following is Fox's assessment of the settlement. So Fox feels that he will meet that 50% test, but suppose if they challenge, then he feels that he might not be able to prove it. So the potential of a 420 savings, the probability is only 40%, 26%. The potential of a 300% saving is 25%. So what does this say? What is the where is it more than likely saving that he will have from this?
Like 300.
300% and $300. And why? Because if he's challenged, he feels that his chances of winning are only 26% to take the benefit of $420 saving. When you add 26 to 25, his chances increase to 51%,
Yeah.
but his savings would go down to $300. So what that really means is his more than likely test falls in what category?
300.
$300. So he has to recognize a liability of
120.
120. He set up a saving of 420, but the probability is only met by 300. He has to recognize he's taken 420, allowed 300. So he must record a tax liability of 120. This is a question on uncertain tax positions. Everybody clear about that?
Yeah.
Okay, so if you have one multiple choice question on that for answer. Okay, now we come to enacted tax rates. Okay, enacted tax rates are rates that are already announced for the current year and for future years. And what do we know about enacted tax rates?
They will be used for computing the deferred tax liability.
Exactly. For computing the deferred tax liability or an asset, we will always use the future rates, future enacted rates. My taxable income is 200,000. Okay. Stone Company began operations in year 1 and reported 225,000 in income before income taxes for the year. Stone year 1 depreciation exceeded the book depreciation by 25,000. Temporary difference. Tax rate is 30% in year 1 and enacted tax rate for years after is 21%. So you have 200,000, 25,000. 25,000 is 225. 25,000 is a temporary difference. What is my current income tax expense?
42,000. 2 lakh into 20.
And what is my, sorry, how much? 60,000, right?
Yeah, 2 lakh into 30%.
2 lakh times 30. What is my total income tax expense?
60,000. 60,000.
65,250, right? Why is it not 30% of 225,000 times 30%?
Because future tax rates are lower.
Exactly, future. So always remember that your current income tax expense plus your deferred income tax expense is equal to your total income tax expense. And your deferred income tax expense is based on future rates. How much is the future rate?
21%.
21%. So 25,000 times 21% is 5250. So my total income tax expense is 60,000 plus 5250 is 65,250. Is that clear?
Yes.
Okay. So what is the end? You make the same entry. Current income tax expense 60,000, deferred income tax 5250, deferred liability, current income tax payable. Okay, so use the past case, use the tax rate in effect when the temporary difference will reverse. So always you have to remember that what this question is telling you is that here, what is the rate that we will use for reversal? What is the rate that we will use?
21%.
The enacted tax rate. Enacted tax rate means the rate which has already been announced. If it is proposed, anticipated, proposed, unassigned, you will not use that rate. Suppose if this question had said that Stone's tax rate for year one was 30% and the proposed tax rate after that is 21%, how much would be a deferred taxation?
30%.
Sorry?
30%.
So how much is the amount?
30% into 25,000. 7,000.
7,500, right?
Yeah.
25,000 multiplied by 30%, right?
Yes.
Okay, so remember very clearly that the reversal should be always based on enacted tax rates, not proposed, not anticipated. Then the same thing, your tax rates will change in the future. So you will change and about valuation, about valuations we discussed, right? If it is not going to reverse, like I will not be able to use my losses, I will do a valuation adjustment. And if the tax status of a company changes also, you might require a valuation adjustment also. So there could be many situations in valuation. Well, let's look at this example here. I have, let me read this question. Jewelry company had previously recorded temporary differences of 10,000. The enacted tax rate was 20%. Okay. The deferred tax liability at the beginning was 2,000, 10,000. Okay, so this was the opening deferred tax liability. For the current year, the taxable income is this much and the financial statement is this much. The 20,000 difference temporary is caused by depreciation. The enacted tax rates are 25%. So what is this question saying now? Okay. So we have in the deferred account, we have an opening balance of 10,000. That balance increases by how much?
20,000.
20,000, because there's a difference between depreciation, which is a temporary difference, it goes to 30,000. So how much is my deferred tax account? The rate is the 21%, is 6,300. And he says that deferred tax liability. So my ending balance should be 6,300. But but there's a beginning balance of 2,000, which I have to reverse here. So there's 43,000 here, $4,300. So 6,300 is my ending balance. My opening is this much. So the change this year has been 4,300. I'll make an entry for that. Current income tax expense, 21,000. My deferred income tax expense, the change that happened this year, 4,300. And deferred tax liability and 21,000. Did everybody understand how we got 4,300?
Yes.
I had my total balance should be 6,300, but I had an opening balance of 2,000. So this year I have to make an adjustment of 43,000, and that is what I did by making this entry of deferred. Okay, balance sheet presentation, we know that this will be either current or non-current, and this will depend upon what?
Timing of reversal.
Timing of the reversal, right? Operating losses, I discussed that with you. Loss carry backwards. Okay, loss carry backwards will not result in a valuation adjustment. Why? Why will loss, if I take a operating loss and carry it backwards, why will it not result in a valuation adjustment?
Amend my earlier income tax return.
Because I'm going to amend my return and I'm going to get a refund. I'm going to get a refund. So if I get a refund, it will not be a valuation adjustment. Only when I lose it, it will be a valuation adjustment. Operating loss carry forward might require a valuation adjustment. Okay. So the valuation adjustment, that example that we did, warrant 21,000, it will give me a benefit of the deferred tax asset account. What was this benefit of $100,000? Okay. Do you remember that example that he discussed here? How did you get 21,000 here? Okay, let me explain you this. In my books, I had taken a total warranty expense deduction of $300,000. Now, that $300,000 was what? It was a provision, right?
Yes.
I made a provision. I estimated that my warranty expenses will be $300,000. So I took a deduction. And what are the other things that we take provisions on?
Bad debt.
Not depreciation, so doubtful debts, right?
Yeah.
Okay. So how do I calculate warranty provisions? I look at the past trend. I find that 5% of my total sales would result in warranty expenses. So I make a provision. So in this particular question, the company made a provision of $300,000. And so what will that result in? If the tax rate is 21%, what will that result in?
Deferred tax liability.
No. Just think. Is it a liability or is it an asset? When I take a deduction, is it an asset or a liability?
Yeah, it will be an asset because I will pay more. I will consider 3 lakh and arrive at the rate.
It will be an asset. Why? Because I'm reducing my taxable income by that much. So I'm going to pay less taxes. I'm making a provision for an expense, which results in an asset and a potential asset. So always remember, expenses result in potential assets. So $300,000 times 21% is $63,000 as a potential deferred tax asset account. Okay. Next year, I spent 100,000. Okay. So I sell cars and I provide warranty for 3 years. In the year of the sale, I will take all the provisions for which will be paid in the next 3 years, and I take $300,000 provision. It results in a deferred tax asset account of 63,000 because it is an expense. Next year, I pay $100,000. So that asset will be reduced by how much?
21,000.
21,000. This is like your 21,000, 100,000. And after that, there are no more warranty expenses. So what will I do?
Valuation adjustment.
Valuation adjustment. Great. Okay. So the same thing here, if you look at the operating losses now. Okay. The pre-tax financial income, the pre-tax financial accounting income and taxable income of ABC were the same for the following years. No temporary or permanent differences exist. 2000, my income was 10,000. 2017, income was 10,000. 2018, it was 15,000. 2019, I had a loss of 60,000. These are the rates. 2020, I had a profit of 10,000, and then 21,000 forward, I'm not going to make any income. All right. Assuming that it is more likely than not that there will be no taxable income after 2020. Assume that ABC elects to use the 5-year carryback. So I'm allowed to take this loss backwards 5 years. Backwards 5 years, and assume that ABC elects to use the 5-year carryback. Prepare the journal entry to record the 2019 income taxes and determine how much taxes will be presented in the income statement and balance sheet. So what is happening? So what year are they asking you to do? 2019. So in 2019, I had a loss of 60,000. I take it back how many years? I'm allowed to take it back how many years?
5 years.
5 years. So I take it back 15,000. I use it. I'm left with a loss of 35,000 carry forward. Okay. So how much is the income tax receivable based on the carry back? On 17, 3,500. 10,000 times 35%. On 18, 15,000 multiplied by 20, 6,650, right? Now, will this be a valuation adjustment or a refund?
Refund.
It'll be a refund because I'm amending the returns. So how much is left here? 35,000. What is the potential of this 35,000 that I have?
Valuation adjustment.
No. What is the potential? How much asset will it create?
35,000 into 21%.
35,000 times 21%. So there's a potential of $7,350 deferred tax asset account, potential saving. But how much can I actually use? Income next year.
2,100.
10,000, right? So I can only use 10,000, 25,000. So there'll be an allowance of how much then?
5,250.
Exactly. 7,350 minus 21% of 10,000 will be enough. So the net realized asset will be basically 21% of 10,000. It's $2,100. So now you'll have a valuation adjustment of 5,250. You created a deferred tax asset of 7,350. So income tax receivable is what you got, the refund you're going to get from this. Income tax receivable, deferred tax, so receivable 6,650, this value, this asset 7,350, deferred tax valuation adjustment, because I'm going to lose this. I will not have income after this year, and my income tax benefit will be the residual. So this is how you will do the entry for this one here, this journal entry. So my current income tax expense will be 6,650 plus a deferred net of 2,100, and that is how you will come up with this entry. Is everybody clear about this journal entry here?
Yes.
Okay. So next one is the dividend received deduction. Now this is what?
Permanent difference.
It's a permanent difference, but the full is not a permanent difference, right?
Yeah, based on the ownership.
It is a combination of temporary and permanent differences based on ownership. So what are the rules? You remember these rules. 0 to 19%, 50% dividend received deduction. So how much is suppose if I receive $100,000, how much is my dividend received deduction?
5,000.
Permanent difference. If I receive $100,000 and I have 15% ownership, how much is my permanent difference, dividend received deduction?
50,000.
50,000. If I have 30% deduction ownership, how much is my dividend received deduction permanent difference?
65,000.
65,000, right? No, sorry. Yeah, 65,000 out of 100,000. And if I have 90% ownership, how much is my deduction?
100%.
100,000. Okay. So remember these percentages: 50% for less than 20, and then 65 and 100. Temporary differences: And the remaining are temporary differences, right?
Yes.
Here, how much is the temporary difference if the ownership is 15%?
50,000.
How much is the temporary difference if the ownership is 30%?
35,000.
35%. How much is the temporary difference if the ownership is 90%? How much?
Nil, zero.
Zero, right. Okay, so you got the concept now. Here I've got basically I got $600,000, and let's read this question again. 25% ownership in a company, so I fall in the 65% bracket. Invested income was 2.4, then 600,000 is gap income. So my gap income is $600,000. My invested dividend received is $500,000 is my taxable income. Invested dividend, he declared a dividend of 200,000.
Mhm.
I owned 25% of that, so I received 500,000 dividend. Okay. So in this $500,000, how much is exclusion?
65%, which is
325. So my taxable on this dividend is only 175, and 21% of that is 36750. How much is the temporary difference on this?
$35,000.
35,000. 35,000 is the temporary difference. If you look at this one here, my total equity is 600,000. 65% of that is 390, because this is permanent, 210. So 75, 210, the temporary difference is 35%. 21% is 7350, and this is my financial. And the entry is the same. Current income tax expense is 36750. Temporary is 7350, then current payable and deferred payable also. So this is a combination of temporary plus permanent differences. So always remember that how you do is you take the dividend received, exclusion, what is taxable. Similarly, this is the total earnings. 65% of the earnings are excluded. This is the taxable earnings, and then this is the total income tax expense, like that. Then disclosures in the balance sheet, in the footnotes, is basically you have to disclose all your deferred tax assets, liabilities, your valuation allowances, and whether it's a current expense benefit or an asset, any losses carry forward, all the stuff. So in disclosures, basically recognize everything that you go. Okay, I'm just going to go over this. This is just for knowledge purposes right now, because you're only studying financial right now. So this is the difference between book income and tax income. Okay, so whether it's a permanent difference or a temporary difference. So we got gap income. Gap income is also called
book income.
gap income is also called
Book income or financial income.
Okay, and this is your IRS Internal Revenue Code tax return. All sales, there's no difference at all. Income, installment sales, they are taxable when received. So this is a temporary difference. Rent and royalties, they are taxable. Rent and royalties in advance, you know that they are not book income, but they are tax income, right? State tax refund is income, so there is no difference. Dividend received, you know that there's a dividend received deduction, so this is a permanent difference as well as a temporary difference. You see the two ticks here? Do you see the two ticks in the dividend?
Yes.
Temporary as well as permanent. Okay. State and municipal bonds is always a permanent difference. Life insurance proceeds is a permanent difference. Gain and loss on treasury stock, there's no difference. Cost of goods sold, there is no difference. Officers compensation. Okay, now this is officers compensation is basically there's a law also which says that you cannot deduct more than $1 million to your officers. So if an officer gets $1.6 million, will that be a permanent difference or okay? Let's look at this question. Say an officer gets $900,000. Will that result in any deferred taxes?
Yes.
Yes or no?
Yes. Yes.
Why?
Because up to 1 million.
No. It will not result in any deferred taxes because I'm allowed to deduct $900,000 for tax purposes as well as book purposes. Okay. Again, same question. Suppose the officer gets paid $1.2 million. Will that result in deferred taxation? Yes or no?
No, permanent difference.
So will it result in deferred taxation?
No. Permanent
No.
difference.
It is a permanent difference. Okay, we got that. Bad debts is always temporary because it's a provision versus actual. Again, warranties is what we example that we discussed is temporary. Interest expense. What is the rule on interest expense? Just credit that rule, right?
Income tax, interest income plus 30% of the allowable taxable income.
Net income. Basically, I can only deduct interest expense to the limit of total interest income plus 30% of the income. So this is that one there. Loss, no difference. Loss, no difference. Depreciation, these all temporary differences. And then goodwill impairment is all temporary. Percentage completion is a permanent difference. Profit sharing is temporary. State taxes paid is no difference. Meals, what is the rule on meals?
50%.
So this is a
permanent difference.
okay, you have to remember also about rules that this 50% rule applies for the year 21 and 22. Okay, life insurance proceeds are life insurance premium expense is a
Permanent difference.
penalties is a permanent difference. Entertainment 50% is permanent. Lobbying or political expenses, any contributions you give to political parties is non-deductible. So it is a
Permanent difference.
permanent. Federal taxes paid is a permanent difference. Okay, capital gains, no difference. Net capital loss, again, if you have a capital loss, it is a temporary difference because you can deduct it against future profits. And operating losses is again temporary, and these all temporary. Research and development can be all three. It can be permanent, it can be temporary, it can be none, depending on the question here. Okay, you want to do these two questions? Do you want to do this question?
Yes.
Mob company reported the following operating income. So income, loss, income. There was no deferred taxes, and mob's effective it takes it to the mob elected to forego the backwards, so it's not going backwards. And mob elected to forego the carry backward of 20. And then what amount of mob should report as total income tax expense in which year? 21. So what is the answer?
Take 1.2 million into 21%.
Okay, 1.2. This is where income statement times 252. Now this is my total income tax because my income is this much, but I have a deferred benefit. So I will say income tax expense 252, the income tax is payable 105, and then I have a deferred tax asset account, which is basically I'm using this losses of 700,000 and taking 21% of that. My expense will still remain at this much times 21%. Total income tax expense will be this much here. So that's the entry that you will do for this one here. Do you want to do this question? As a result of differences between depreciation for financial reporting and tax purposes, the financial reporting basis of Noor Corporation asset acquired exceeded its tax basis by this much. The difference will reverse in future. The enacted tax rate is this much for year 1 and 21% for future. Noor has no temporary differences. So the question is, read the question very, very carefully. It can ask you a lot of things. What is the current expense? What is the total expense? Whether it is a deferred tax liability, how much is it? So the question is saying that the enacted tax rate is that Noor has no other temporary difference. In its December 31st year 1 balance sheet, how should Noor report the deferred tax effect of this difference? So firstly, will it be a liability or an expense?
Liability
And how much would that be? How much is the difference?
is 2,50,000. So 2,50,000, 21% would be 50,000, 52,500.
Why 21%?
Because the enacted rate in future year would be 21%.
Right. Exactly. Yeah. So that's the answer. Okay, that brings us to the end of this chapter. So what I was going to suggest was that why don't we take tomorrow off and next weekend off also, if it's okay with all of you. I'm okay to teach tomorrow also, but rather than just two modules of F7,